I ran a stock screener the other day, and I came across a few companies that I think deserve a deeper look. Uh, Even though I've never heard of them, I think that they have some value potential, some big upsides, and I want to take a look. So this is the first one that I looked at, and I was very excited what I saw as I ran through the numbers on this company. It's called Insteel Industries Incorporated, ticker IIIN. They're a very strong grower with a 3-year compound annual growth rate of 22% on their revenue and 32% for the last 2 years. And everything is a green flag here. They've been doubling, tripling their earnings year over year, moving from 29 cents to $6.41. Now, this year, analysts are expecting a bit of a hiccup, dropping it down to $2.48. We'll see if the analysts are correct or not. Even if that is true, they were already such a value play that's fine. If it is a hiccup and they're able to get back on trend, back up to 384, which would still be higher than what they did in 2021, then we'd be looking at less growth in the earnings, but still a very strong, solid stock that's undervalued. We have a few things that we like to look at in the stocks, and this is how it comes into my radar. We look at companies that have a high ROE, a return on equity. Specifically, I'm looking for something at least 20%, preferably 40 to 60 is ideal. This 32% this last year, and they've been growing it year over year. In 2019, it was 2.3, then 7.2, then 22.1, then 32.1. Their ROE has been growing at 141.5% year over year. Let's hope that trend can continue. But I look for a company that at a minimum pays a dividend. This company, it pays a dividend. It pays 12 cents a year in dividends, 3 cents every single quarter. But they have been doing special dividends. In 2020, $1.50. In 2021, $2. In 2022, $2. I'd hope that they continue that moving forward. If they do, and that can be a special dividend that we can depend on, as they've paid them out for 3 years in a row now, we'd be looking at nearly 7% dividend yield, which is incredible. That's a very high yield. Without that, it's only a 0.65 dividend yield. So that might be why it's not hitting the radar of some dividend investors, because that special dividend, you don't know if you're going to get it or not. But the fact that they had negative cash flow this last year and still paid it out, I think that it's going to become a real thing. I don't see why they don't just raise their quarterly payouts. But maybe it's if they hit a certain goal come the end of the year, they pay it out along with their normal dividend in December. But we'd like to see a decent gross profit, preferably, at least 20%. And we see that's another thing that they've been growing: 6.6, 11.8, 20.6, 23.9. If they can continue growing their gross profit percentage at 53.5% year over year, that would be incredible. And they'd end up where we want them. Expenses as a portion of revenue, they've been good at decreasing this. 98.8, 94.8, 84.9, 80.5. They've been decreasing this over 6.5% year over year. So they might not necessarily be there on some of the things that we look for, but they are well on their way, and they're showing incredible strides every single year. I believe that covers the financials for the most part. I worked in this dividend or this earnings yield here because apparently that's what Graham liked to look at for stocks to invest in. He'd see what their earnings yield is, and their stock would always be a buy if the earnings yield was more than you could get with the Treasury. Well, I believe that 22.9% is more than you can get with the Treasury. This year it drops down to 7.8. Still, that is a good return. Anywhere from 2021 through the projections of 2023 would be a good time to buy, according to that metric. If we look at share count, shareholders' equity, free cash flows, we do see that they have had 2 years of negative free cash flow. I need to dig deeper into this. This is just a brief overview of the company. I really like what I see. Now I need to dive deeper into it and see how much do I want to invest. It's clearly one that I want to be buying. Do I want to buy 100 shares, 200, 500? We'll see once I build up a thesis on what's going to drive growth to the company, where they can trim expenses, boost margins, drive more revenue. If you want to see something like that, have me put out a video for my investing thesis in a company like this. Please like and subscribe. Let me know that that's what you guys want to see, and it'll be my top priority. Otherwise, I'll continue running through the list of the other stocks that I found through screeners and do that in the background. The balance sheet, they are very solid on their assets. They've been growing them at an incredible rate, 17.2% year over year. Heavy on the tangible assets, growing those even faster than their total assets. Their liabilities have been growing rather quickly, 20.39, but they are nowhere near the magnitude of the assets. 1/5, less than a fifth of what their assets are. So we end up with a solid debt to equity ratio. You want this as low as possible. Anything over a 1 is a definitely do not invest. Below a 0.25 is very nice. So 2022 really put them in the range for at least something that Graham would buy, between the earnings yield, the debt to equity ratio. We see that the book value per share is $19.12, which is pretty incredible for a stock that's trading for $31.79. They have quite a bit of cash. It is down. They did seem to spend quite a bit this last year. When we look deeper and build our thesis, we'll see what that cash was used up on. If it was used up on a higher margin investment, or if it was just wasted. But that comes to cash per share of $2.48. And then we already talked about the dividend, the share price. We've seen this stock move kind of slowly. I mean, 2021 was a good year for it. It started in 2019 at $18.49. And then it moved up to nearly $21 by the end of 2020. 37.5 by 2021, 28 by the end of 2022, and it currently sits around $32 a share. We talked about this ROE, the PE ratio, with those super high earnings that I had this last year. That put it at a PE ratio of 4.36. Analysts don't expect them to keep that up, but even before then, 2021, we're going to see numbers similar to that in 2024. They were trading for a 11 PE, which is very low for a stock that's growing its revenues at 22% and its earnings over 100%. This should be one of those stocks that's trading at 30, 40, but it is probably a more cyclical company. It's very reliant on resources. It's a steel company. They do rebar and bridges, and one of their complaints about their progress this year was how close the price between raw steel and rebar steel is. And then we have all of our calculations down here for what a fair value on this stock might be. So I did it pretty evenly weighted between earnings, cash flows, balance sheet, and then the dividend barely even factors into it because they're definitely not a dividend company. And with where they currently stand and how much revenue they're driving, I wouldn't expect them or really want them to pay out a huge dividend. I'd want them to be reinvesting back into the business and continuing this growth. But we see that they are pretty close on a lot of metrics. I mean, this last year, the negative cash flow hurt them a little bit. Their earnings being so incredible really helped them. Their balance sheet and their dividend all together put it at about $67 using this weighting. This year, if they're able to come in on trend and expectation, I'd be looking at something close to $58 for a fair value. And moving forward, if they can continue on all their trends and expectations, we could see 104, nearly $105 come 2024. We'll see if they can continue this 22% revenue growth and this 180% earnings growth. These numbers come from analysts. These numbers come from trend. And as well as the balance sheet numbers, those come from trend. Personally, I would be willing to pay something up to $56 for the stock if they're able to deliver this year. As of the end of last year, 71. So we're seeing a bit of a dip, and that is going to be a buying opportunity for us. So for value investors, our buy and sell zones would be here. 50 and below would be a sure buy, a strong buy. And a sell would be something, at least above 64. As for the discounted cash flows, to see what if this is more of a growth company, I'm coming up with a good value of $61.52, which is pretty close to what we're seeing for the fair values between last year and this year. So I feel like that helps confirm that this stock is a sure buy, but we just need to dig a little deeper and see, what's going to drive that growth that we're expecting. Are they actually going to be able to deliver on that? Hopefully I can find more like these. This is what I'm going to focus my portfolio on, stocks like this that just the market hasn't realized what it's got here. And I will share every single second of it with you guys. So thank you for watching. Again, please like, comment, subscribe. Let me know what you want me to take a look at. If you disagree with me, what do you disagree about? And are you going to buy too? I'll catch you guys next time.